I will show real-life examples for the Ulta Beauty stock. This is episode number 5. In this video we will go over a stock price calculation method which will give us enough competency about the stock buying price. We'll learn about stock price prediction methods, then we'll calculate today's buying price based on the future price. Then we'll use the margin of safety to find the best safe price we should pay for the stock to be sure we don't overpay for it. You must exactly know what is your safe buying price, because if you overpay, your future returns will be slaughtered. This is episode number 5, which is all about study number 4 of our full investment analysis. And the title is Price of the Stock. If you have missed our previous video, you can go back to our videos and start watching them from episode number 1. Or you can just click on the card here to open the playlist. But before we start, please make sure I'm not a financial advisor and I don't provide any investment recommendation. And in this video, which has an educational purpose only, I only share my thoughts about various stocks. Before you invest in anything, please do your own research and analysis. Also, make sure you subscribe to this channel to receive our weekly videos if you want to expand your financial skills. Okay, let's start. There are many ways to calculate the intrinsic value of a stock. Even many value investors do it differently. One investor uses the 10 or 20 years discounted cash flow formula. Another investor uses other systems. Phil Town teaches 3 other formulas, which are the margin of safety price, the payback price, and the 10 cap price. My calculation method is a little different from all of them, but the logic behind it is mostly close to the margin of safety price calculation method founded by Phil Town. Let me describe it. As a long-term value investor, firstly we need to predict what will be the stock price in 10 years, and after that only we calculate the current safest price we are willing to pay for the stock to meet our investment goals. So there are 2 steps. Step number 1 is to predict what will be the stock price in 10 years, and step number 2 is to convert it to today's price. So to find out what will be the stock price in 10 years, we need to forecast the business growth rate first. How do we do it? Let me bring an example. We go to the macrotrends.net website and search for Ulta Beauty, which is a great example of a wonderful company. Let's say we already have gone over all investment studies for this company and we already love it and want to own it. Considering that we have a company that has an excellent consistent growth as I described in study number 2. By the way, if you have missed that video, click the card here to learn how we find the most wonderful companies based on the financials of the company. Okay, we go to the price ratios as the main section and choose the subsection of PE ratio here, as the info is presented very plainly. Here we see the per share data together with data that shows the comparison of that data to the price. In other words, you see the stock price in the first part, then the per share data in the second part, then in the third part you see the multiplier, the ratio that is the price divided by the per share data. On this page we take the latest data of earnings per share by keeping the mouse over it. Also, we fix the date of that data. In this case, it is January of 2020 and the earnings per share is 12.16. We take that number and put it in our calculator ahead of the field called today's amount. After that, we go back 10 years and take the January data of 2010. So we take the data of 0.66 and we put in the calculator for the field called initial amount. And in the next field called years, we put 10 and the calculator shows us that the annual compounding interest rate is 34%. Don't worry about the functions behind the calculator. You can go to this video description where I will put the link to this Google Sheet so that you can download and use it for your own analysis as well. Also, you can see the functions in the online version. So this means that earnings per share has been growing for 34% annually for the last 10 years, and we take that 34% and put it in our table in the column which shows the 10-year compounding rate for earnings per share. And we do the same process for 7-year, 5-year and 3-year columns, as well as for sales per share, book value per share and operating cash flow per share. After that, the table shows the results of that data, which is the average data for those numbers. So in this case we get 27, 20, 15 and 24% as an average growth rate for the data like earnings, sales, book value and operating cash flow per share. Having these four growth rates, we decide ourselves what will be the most realistic overall growth rate for the business. We try to take the conservative average for those four growth rates, as the growth rate is one of the most important numbers in the future stock price prediction process. We try to be very conservative. First and foremost, I consider 20 for any growth rate which is above 20, as it's really a big number for the growth rate, as not every business can be growing for over 20% annually and for decades. This is less realistic, so I consider those 27% and 24% growth rates as a 20% growth rate. And in this case we will have three 20% growth rates and the 15% growth rate. In those cases I usually take maybe from 16 to 18% as a total conservative growth rate for the business. Let's put it 17. So I think Ulta Beauty will grow at a 17% rate annually for the next 10 years. So we finally have that number, the growth rate for the next 10 years. The next thing we do is take those four numbers of current earnings, sales, book value and operating cash flow per share data and increase it with our 17% growth rate annually for 10 years, so that we can know what those numbers will look like in 10 years. In this column we have the results. These three columns data is relative to 10 years later. Now we should find out what will be the multiplier in 10 years, so that we can multiply the per share data in 10 years with the multiplier in 10 years to get the share price in 10 years. That's it, very simple. To get what will be the multiplier in 10 years, we need to understand the historical multiplier and take the realistic value from there, which will be above the average number, but not the highest number. Why don't we take the average and take the above average amount? Because we really want to sell our businesses when they are rocking, not when they are growing with their standard flow. As Philtown explains, we really want to sell our businesses when they are doing very well, even sometimes better than they should do. So I'll bring the example on the earnings per share data, but you should do the same for all four of them. Let's see what is the historical PE ratio of Ulta Beauty. So it has been in the range between about 13 to 46, but mostly it has been within the range of 23 to 38 maybe. So the average would be 30 or 31, but the better average number would be 34 or 35, I think. So in this case I would take the 34 as the multiplier. Also, it is a very famous best practice to take the P ratio twice the growth rate. So in this case it's absolutely identical. Definitely the 34 number will be our multiplier for the earnings per share. The same we should do for other three metrics as well. And we should finally multiply the per share data with the forecasted multipliers to get the share price in 10 years. So in this column we will get the forecasted share prices based on certain metrics. And if you get close numbers, it is an indicator that we are doing something right. And from these four forecasted share prices, we will take the one that is below average, the conservative number. In this case, I took about $1,700. So we can say that our analysis shows that Ulta Beauty should have been trading at around $1,700 in 10 years if we didn't have an economic collapse as in 2020. So please take into consideration that these calculations are based on the data of up to January of 2020. After that, we had an economic shutdown, so so don't take into account those numbers for even a rough calculations. This video example is only for educational purposes. By the way, hit the like button. That like button is really important for us if you'd like to support this channel. As we have the 10 years forecasted share price, it's the right time to go to step number 2, where we will convert that number to today's number to understand what price we are willing to pay today to have a successful investment. I usually divide the 10-year forecasted price to 8 to get my today's buying price. In this case, I divide 1700 to 8 and I get about 212. So if I can get Ulta Beauty stock at about $212, that would be the greatest opportunity for me. Let me explain why I divide it into 8. In short, I divide the 10-year forecasted price firstly to 4, then divide again to 2, which together is basically the same as dividing to 8. I divide it to 4 because that's my target for my investments. If my investments grow at least 4 times in 10 years, that will make me really happy, which is basically the same as getting about 15% annually on my investments. As you have noticed, the 15% annual return is my goal, and if yours is another, then you can adjust the division to 4 part to your number. And later, why I divide to 2? Because I love to buy things using 50% margin of safety, which gives me a big capacity to be twice incorrect on my forecasts, for which I sleep well at night. Basically, 50% margin of safety is almost the same as discounting 7 to 8% annually on the growth rate while calculating the intrinsic value. In other words, if you discount any realistic growth rate with 7 to 8% annually, you'll get the same number in 10 years as you just don't discount at all and at the end drop the buying price by half. So that way we'll be safe enough for the future as we try to buy $10 bills with $5, as Phil Town likes to say. We try to buy companies on sale to have the lowest risk in the deal, to meet Warren Buffett's rule number 1 and rule number 2. As Warren Buffett says, rule number 1, never lose money. Rule number 2, never forget rule number 1. And that's why we drop the risk by 50%. The conclusion is that the current intrinsic value would be about $212 for the Ulta Beauty stock if we didn't have an unexpected economic collapse. So again, don't take those numbers as a basis for your analysis, as a lot has changed this year and all metrics have dropped vastly. There are 3 more important things I need to mention. First one is that Macro Trends website provides the price to earnings, price to sales, and price to book value per share data, but not the price to operating cash flow, for which you can visit Guru Focus website. In Guru Focus website, you can find the ratio and the operating cash flow itself. The second thing I need to mention is that you also can find similar analysis done in Rule 1 Investing website. And the final thing I need to mention is that if you analyze a dividend paying company, then you should add a dividend to the book value calculations as well, as that is the amount that is deducted from the book value. The next episode, number 6, will be all about the investor's mindset, psychology, behavior, skills, and competency. Watch it to know how you can think like a successful investor in order to gain success. Now please make sure you subscribe and hit the bell icon to get notifications when I upload a new video so that you don't miss it. And if you could take any value from this video, please hit the thumbs up button and share with your friends. And don't forget to leave your comments below, as I really want to know what are your buying price calculation methods. Thanks for watching. Watch the next video.